Okay, so I've learned something, Jazzy's learned something, we've all gone and learned things. Let's get into it. Okay, so in reflection of the video that I posted, the deep dive of Jazzy128, Jazzy came back to me and, first he said, thank you for choosing him as my first deep dive, all the niceties, etc., etc. He did come back to me with a personal email, basically confronting why I gave him a 2 out of 10 for the reinvesting portion of the deep dive. And he didn't fully understand where I was coming from. So let's quickly go into it here. So this is one of my emails to Jazzy. I gave an example because we was trying to get to the bottom of, I thought I was right with how I was explaining it with the snowball theory. You have a trader that closes frequently and you get a snowball effect. A trader who doesn't close very often and does not have a snowball effect. That's where I was coming from. And Jazzy was confronting me, kind of either saying the opposite or that they both cancel each other out. He gave an example. So trader C, who's a frequent closer, initial equity is 10,000, month 1, 10% profit on all items, closes them all, and you get 11,000. Okay. Month 2, the new equity is 11,000, 10% on all the items again, you close them all, you get 12,100. Okay, so following the same pattern of getting 10% every month on every item, you trade in everything, you put all your equity on all the trades, 10% every month, doing the same thing for 10 months. So in total, Trader C has gained 100% in 10 months because he's done 10% per month times 10. So the new equity is 25,937. Okay, so Trader D, he never closes. Initial equity $10,000. Month 1, 10% profit on all items, keeps them open, doesn't close them. 11,000. Month 2, another 10% profit on all items, still open. 12,000 as opposed to the 12,100. 100 less than Trader C. So following this same pattern, like in the above example, I theorized that Trader D, again, 100% in 10 months, because it's 10% each month times 10, the new equity would be 20,000. Whereas compared to this one is 25,000. So that's where I was coming from. That's what I thought. Okay. And then in the final email, Jazzy sent me, so Trader D example is where the misunderstanding lies. He's saying it's mathematically wrong, even though at the time I put it on, Excel spreadsheet and calculated it correctly. But what he's actually saying is that formula, which is just basic interest maths type thing, is for single interest. It's for single interest. Okay. So he's saying in the Trader D example, he would have achieved $20,000 at the end of it, only if he withdrew his profits every day into his bank and then leaves the original equity unchanged. This is not the case in my example, though. In your example, Trader D leaves his positions open, which follows the compound interest formula, not the single interest one. Okay, this is where it started to get interesting for me. Like, okay. So he sent me a video and a link, which I've watched. Explains the difference between single and compound interest. Right, so long story short, it would appear that this single interest is not actually how eToro works. If you put $100 on a stock and it gets 10% profit in day 1, you have $110. Next day rolls around. Let's say that stock goes up another 10%, just like in the first day. Okay, so I thought you'd get $120. So the $100 plus 10%, $110. Next day, plus 10%, 120. Okay, because I thought it was based on the original equity amount, which I'm sure it must be. A lot of people must think this. But yeah, but how in fact it actually works is you put you start with $100. In day one, you get 10%. So you get $110. The next day, the stock goes up 10% again. How much do you get? You get 121, because not only did you gain 10% from the original amount, which was $100, but you've gained 10% from the profit you made, which was $10. So you've gained 10% of $10, which is $1. Okay, so how this compound interest thing works is that you're making interest or gains, if you like, off of your previous interest or gains. And it just keeps on going, aka the snowball effect. So whether you're closing trades or not closing trades, we are having the snowball effect. So I need to revisit how I review traders on that last point, the reinvesting section. I might need to scrap that last one entirely, because the snowball effect applies to everyone, no matter if you close frequently or not. So let's have a look at the last point here. Okay, so where you've actually got a really good point is with the divergence of performance between popular investors and copiers. So I brought it up that he started his account 9 months ago, and if, for example, he didn't close anything for the whole 9 months, he would be in a good position. A copier that copied him at the start of the 9 months, he would also be in a good position. But a guy who's only copied him 1 month or 2 months ago, say for example, maybe the new copier's stats are in red. But Jazzy doesn't know this, because on his screen, it's all really green. It's like 100% profit. So he's happy. It's like, oh yeah, anyone who's copying me, that's fine. I can close it at 80% if I want. Everyone's still going to be happy because they get a huge gain. But in reality, the trader who's copied a month ago, depending on if the stock fluctuates, he could be in red. And then suddenly Jazzy comes along and closes it. And it's closed in red. It's not just temporarily in red. You made a loss. So I brought that attention to Jazzy, to one of the points for the pros and cons of closing frequently and holding forever. So he said, I must admit I was not aware of the fact that the copiers copy invested and not the value when you copy one's portfolio. In this case, if copiers copied value, the popular investor's stats and all copiers' stats would be identical, which initially I thought when I first started. It made sense to me, as it did with me. Why would eToro let copiers copy a portfolio that no longer exists due to high gains or losses? He actually ran this by eToro as well, and they affirmed that the copiers copy value, and he even calculated it with his early copiers, but my video prompted him to run the calculations again with newer copiers, where he found out that they do indeed copy invested instead of value, resulting in stark divergence between PI performance and their performance if the position is left unchecked. That made him rethink how he opens and closes positions, and have come to a conclusion that from January 2021, he will be closing all positions that exceed 100%. Woo! Yeah! We made progress. We can increase Jazzy's stats now. He's increased 2 points, and then reopen them immediately, so his performance and the performance of his copiers are better aligned. Fantastic. He'll also increase his affordability, which was one of the points in the graded review I did on the deep dive for Jazzy. Keeping his smallest position at 0.77%, in line with the other positions, so that anyone can start copying with $200. Woo! Yes! I'd like to thank you for prompting me to realize that. Absolutely fantastic. I will revise the Jazzy jazzy128 deep dive now. In reflection of this news, the review will be reflecting half history and half projected for 2021. Okay, so these are the new revised graded breakdown on jazzy128's deep dive review. I'm only going to cover the elements that's changed in reflection of the new information from Jazzy for his projected changes in 2021, and also the information that we've just discovered about compound versus single. So the first element that's changed on the deep dive review is the portfolio quantity. I was a bit harsh last time saying that having 100 items would be a 10 out of 10, and 0 items or 5 items is a 1 out of 10. So what I've decided to do here is 5 items being a 1 out of 10, and then going up in multiples of 5. So 60 items would be a 10 out of 10. Jazzy has 65, so he is a 10 out of 10. The second one that's changed is affordability. It was a 9 out of 10. But as Jazzy has mentioned, in 2021, he will be basically changing how he trades, the trade sizes. So he'll be making sure that people can copy him with the minimum $200. Gives him the maximum affordability, being a 10 out of 10. Lastly, trade frequency. Now this was the one that was titled reinvesting or reinvestment. And the whole reason I had that there was because I was under the assumption, as I'm sure a lot of people are, that if you keep closing the trades in profit, then all that money goes back into you, and that's how the snowball effect occurs. I had no idea, as I'm sure a lot of people don't or didn't, that compound interest exists on eToro, which snowballs itself whether you close or not. So instead of removing the bottom one altogether, what I've decided to do is essentially rename it to trade frequency. So I'll tell you how I've calculated this and how I will calculate it for future videos. So this is going to be how many trades have been done in 3 months in the history section of a trader's portfolio. If someone's done 50 trades, like Jazzy has in the 3 months history, they'll get a 5 out of 10. If they've done over 100 trades, they'll get a 10 out of 10. Yeah. So as a result of the email chain that Jazzy and I had, we've, as I said, we both learned things. He's now, there's 2 key things that he learned, and one of them was he's going to be closing the trades when it reaches 100% profit. He's not just going to let it go forever, because you need the synchronization between the PI, the popular investor, and the copier. The more often that you're opening and closing trades, the more likely that the copier is going to get on that rocket before it blasts off and you get that profit. That didn't mean to rhyme. Whereas if someone opened a trade 6 months ago and they get on the rocket now, it may have already hit its peak. If not, it's probably nearly on its way there to hitting the peak. And I'm sure with Jazzy, the trade frequency, 5 out of 10, will increase more next year once he's implemented his changes. Okay, that does it for this video. Thank you very much for watching. I hope you've learned something with the compound investment. I saw actually on eToro a second ago that basically I was commenting on one of Jazzy's posts asking for some information about the compound. Another trader popped by on the comment saying, "Oh, this is very helpful, actually. Thank you." And now, as a result of that, Jazzy's going to create a post as well talking about it. So let's get this information out there. I started in eToro solo trading in 2019. I think it was like March, end of March. So, I mean, I've been familiar with eToro for over a year now, coming up to 2 years in next March. And I never knew about the compound. I mean, that's such a positive thing as well. You know, it's very important and it's very positive. People need to know about this. Why don't more people know about it? Compounding works real time. Real time. Real time. But eToro incorporates it in the number you see every day, meaning if a given stock goes up by 5% and then adds another 5% during the same day, eToro will show the given gain as 10.25%. But yeah, take it easy, and thank you again, Jazzy, for bringing this to my attention and having a chat with me, and both learning some things in the process. So yeah, take care, everyone. Thank you very much for watching.